Competitive rivalry. Los evaluate the relative competitive rivalry in a given industry. Evaluating competitive rivalry involves assessing the intensity of competition among existing firms and its impact on profitability. High rivalry is often characterized by frequent price competition, aggressive marketing campaigns, rapid product innovation, and margin compression. Indicators include declining industry profitability, increasing promotional spending, and market share volatility. When firms compete aggressively for limited growth opportunities, rivalry intensifies, raising strategic risk and reducing overall industry attractiveness. The evaluation must consider industry growth rate, market saturation, and product differentiation. In slow growth or mature industries, firms can only expand by capturing competitors' market share, increasing rivalry. Conversely, in high growth industries, firms may grow without directly displacing competitors, reducing competitive tension. Commoditized products typically lead to price-based competition, while differentiated offerings reduce rivalry by allowing firms to compete on quality, branding, or service. Additional factors include capacity levels, cost structures, and competitive balance. Excess capacity encourages price reductions to utilize fixed assets. High fixed costs increase pressure to maintain production levels, intensifying rivalry. If competitors are relatively equal in size and resources, rivalry tends to be stronger, as no single firm can dominate easily. Evaluating these variables provides insight into the sustainability of industry profits and strategic positioning. Los Analyze industry competitive structure and its relationship to the level of competitive rivalry. The number of competitors and relative size distribution significantly influence rivalry. Industries with many similarly sized firms often experience intense competition, as firms aggressively pursue market share. In contrast, industries dominated by a single firm or a small number of stable players may experience more controlled competition. Fragmented industries tend to have localized rivalry, while consolidated industries may exhibit strategic interdependence among dominant firms. The rate of industry growth directly affects competitive behavior. Rapid growth can reduce rivalry because firms expand alongside overall demand. However, slow or declining growth increases competition for existing customers, intensifying price wars and promotional activity. Industry life cycle stage therefore plays a crucial role in determining rivalry levels and long-term profitability potential. The nature of the product, fixed cost levels, and exit barriers further shape rivalry. Commodity products increase price-based competition, while unique or differentiated products reduce direct comparability. High fixed costs create pressure to operate at full capacity, encouraging aggressive pricing. High exit barriers, such as specialized assets, contractual obligations, or emotional attachment, keep struggling firms in the industry, prolonging excess capacity and intensifying rivalry over time. Financial analysis of competitors. Los Perform a financial analysis of competitors and interpret ratios. Performing competitor financial analysis begins with assessing profitability, leverage, liquidity, and efficiency ratios to understand financial strength and strategic positioning. Profitability ratios, gross margin, operating margin, ROA, ROE, reveal cost control and value creation effectiveness. Liquidity ratios, current ratio, quick ratio, assess short-term financial stability, while leverage ratios, debt to equity, interest coverage, evaluate financial risk exposure. Efficiency ratios, inventory turnover, asset turnover, indicate operational effectiveness. Interpretation focuses on trends over time and benchmarking against industry averages rather than isolated ratio values. Evaluating market pricing, dividend policy, and growth rates provides insight into strategic direction and investor expectations. Valuation metrics such as price-to-earnings or market-to-book ratios reflect perceived growth prospects and risk. Dividend payout ratios indicate whether management prioritizes reinvestment or shareholder distributions. Revenue growth and earnings growth trends reveal competitive momentum. Strong growth with stable margins may signal competitive advantage, while declining growth or volatile earnings may indicate strategic vulnerability or industry pressure. Analyzing cost structure and financial flexibility is critical for understanding competitive resilience. A high fixed cost structure increases operating leverage, amplifying profits during growth but increasing risk during downturns. Reviewing cost of goods sold and operating expense patterns highlights efficiency or pricing strategy differences. Firms with strong cash flow, moderate leverage, and access to capital markets possess greater flexibility to invest, innovate, or withstand economic shocks compared to financially constrained competitors. LOS pages demonstrate understanding of common size income statement analysis and its use in evaluating competitor strength. A common size income statement expresses each line item as a percentage of total revenue, allowing comparison across firms of different sizes. By standardizing financial data, analysts can evaluate relative cost structures, margin performance, and profitability patterns without distortion from scale differences. This method highlights how revenue is allocated among cost of goods sold, operating expenses, interest, and net income, providing insight into operational efficiency and pricing strategies. Common size analysis enables comparison of gross margin, operating margin, and net profit margin trends across competitors. A company with consistently higher gross margins may possess pricing power or superior cost control. Higher operating expense percentages may signal heavy marketing investment or inefficiencies. When compared over multiple periods, changes in expense ratios can indicate strategic shifts, cost restructuring efforts, or competitive pressures affecting profitability. This tool also supports assessment of financial strength and flexibility. Firms with lower interest expense as a percentage of revenue may have lower leverage and reduced financial risk. Stable or improving profit margins suggest resilience and competitive advantage. Conversely, rising cost percentages or declining margins may indicate vulnerability. By focusing on structural relationships within the income statement, common size analysis provides meaningful comparative insight into competitor financial health. Innovation, change, and market disruption. LOS QQ explain how innovation, change, growth, and market disruption can be both a threat and an opportunity. Innovation and technological change can create significant growth opportunities by enabling new products, improved efficiency, enhanced customer experience, and access to new markets. Organizations that lead innovation may establish first-mover advantages, strengthen brand differentiation, and build high switching costs. Growth resulting from innovation can increase economies of scale, market share, and long-term profitability. Firms that proactively invest in research and development or digital transformation often convert change into sustainable competitive advantage. At the same time, innovation and disruption represent substantial strategic threats, particularly to established firms relying on legacy products or business models. Disruptive technologies may render existing offerings obsolete, reduce demand, or erode pricing power. Market entrants leveraging new platforms or cost structures can rapidly capture share. Organizations that fail to adapt may experience declining revenues, stranded assets, and loss of competitive relevance. The strategic impact depends on a firm's adaptability and responsiveness to change drivers. Companies that monitor trends, diversify investments, and foster a culture of innovation are more likely to benefit from growth and disruption. Conversely, firms resistant to change face heightened strategic risk. Effective strategic management balances opportunity exploitation with risk mitigation, recognizing that change is both inevitable and potentially transformative. LOSARA. Explain the importance of implementing a formalized monitoring or early warning system. A formalized monitoring or early warning system systematically tracks environmental, competitive, technological, regulatory, and macroeconomic indicators that may signal emerging strategic shifts. Rather than relying on informal observation, organizations establish structured processes for scanning trends, analyzing data, and reporting insights to leadership. This disciplined approach reduces the risk of industry dissonance and strategic surprise by identifying change drivers before they materially impact performance. Early warning systems help detect weak signals and leading indicators of disruption, such as changes in customer behavior, competitor investments, patent filings, regulatory proposals, or supply chain instability. By recognizing early signs of industry transformation, management can reassess assumptions, conduct scenario analysis, and adjust strategic priorities. This proactive approach enhances agility and supports informed capital allocation decisions. Implementing such systems also strengthens enterprise risk management and strategic alignment. Clear reporting structures, defined metrics, and accountability ensure that intelligence insights are integrated into planning and budgeting processes. Regular review cycles promote continuous learning and adaptation. Ultimately, a formal monitoring system enables organizations to anticipate change, reduce strategic risk, and maintain long-term competitiveness in dynamic environments.